be, I'ma 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 be.
Okay, Assalamualaikum and good morning class.
Good morning.
Okay, let's start our class with Ummul Kitab Al-Fatihah. Okay, at the end of the class, we will be having a quiz on last week chapter, which is ordinary share capital. So for today, can someone volunteer to explain what is common stock and preferred stock?
What I know, the main component of equity in a firm is common stock. Common stock also refer the owner in the firm, so that is the last ranking distribution of a firm income. Under residual income principle, all the income generated by a firm is first paid as interest, then preferred dividend. Remaining earning may then distribute to common stock as an ordinary dividend. There is no fixed amount to be paid to ordinary dividend. For the preferred stock is part of the equity. Sometimes it's called hybrid of equity, and that in certain cases it is similar to common stock where it does not have a maturity date. The first dividend is paid from a firm earning after interest are paid, and most preferred dividend carry a fixed amount. If a firm bankrupt, preferred stockholder are ranked ahead of common stockholder, but after the creditor is the cash distribution after its asset of a firm have been liquidated.
Based on what Alizul has mentioned earlier, can you add one more method on the issuance of share and explain about rights?
Besides what has been mentioned by Azizul earlier, share also can be issued through private placement. Private placement occurs when a company makes an offering securities or raise capital not to the public but directly to an individual or a small group of investors. For example, pension fund, large bank or insurance companies. New issuance and firm value. Stock price decline when a company announces a season equity offering. The decline due to the private or insider information or known as asymmetric information. The cost of new issuance. No exploitation cost can be determined by looking at the direct expenses, for example, filing fees and legal fees. Right, under right has three. First is right offering. The existing shareholder will be offered rights to buy new share in the firm. Second is X right price. The subsequent buyer buy the stock after the holder of record date. Third is effect on shareholder. Shareholder wealth will not be affected if the share price is below market price, but if the price is too high, the firm will not get good response from the shareholder.
Okay, Khairul, can you explain on dividend and its policy?
Dividend. Dividend are return received by shareholder. It is periodic distribution of firm earning to its shareholder. Dividend may be in the form of cash or stock dividend. Dividend policy. Dividend policy determines how much of the firm earnings should be paid to shareholder dividend and how much retained. Form of dividend policy. First, high relevance of dividend policy. Second, high dividend and low dividend. Third, other argument. And lastly, alternative dividend policy. Irrelevance of dividend policy. Irrelevant theory states that the amount of dividend that firm pay is irrelevant. Second, high dividend and low dividend. High dividend policy is based on certainty of dividend income as opposed to a certainty of future capital gain. Low dividend policy is based on the argument that dividend income is taxed immediately, whereas capital gain are not taxed or taxed later in the future. Other arguments. Expectation theory dictates that firms have to take into account the market expectation when making dividend decision, signaling an asymmetry of information. The amount of dividend paid out might signal to market about the future prospect of the firm. Client effect. Treat shareholder as client of the firm. Firm will attract the client whose dividend preference in line with the dividend policy of the firm. Residual dividend theory advocates that firms should first allocate fund for profitable investment and payment to creditor, which the residual balance to be paid as dividend.
Okay. Did all of you still remember on repurchase of stock, stock split and warrant?
Yes.
Okay, Kina, can you explain and recap it back? Okay?
Repurchase of stock will result in the number of shares in the secondary market being reduced. For example, is to enhance the company value or increase the management's control over the company's business activities. The benefit is improve a firm's earning per share and can reduce the amount of dividends that a firm needs to pay in the future. Under stock split, a firm increase the number of shares outstanding while reducing the worth of each share. Example is Kina Berhad's original share are at par value of RM1 each. The firm now announced a 2-for-1 stock split. This means you will get 2 new shares in an exchange of 1 old share. For each 100 old shares held, shareholders receive 200 new shares to replace the old shares held. The new shares would carry a par value at 50 cents each. Warrants give the holder the right but not the obligation to purchase shares directly from the firm.
Izzati, today we got advanced online quiz, right?
Yes, how come we forgot?
Oh no! Calculation?
In this chapter, there are 4 types of calculation. The first one is the stock valuation on preference share, and the other 3 is for common stock, which is the zero growth calculation, constant growth calculation, and lastly is the variable growth calculation. Okay, for the first calculation on stock valuation of preferred stock, the question is, what is the value of preferred stock if Atul pays an 8.5% dividend for its preferred stocks on RM50 par value, assuming Atul's required rate of return on the preferred stock is 9.9%. Assume that the market value is RM50. Should Atul buy the preferred stock? Okay, the answer for this question is to know the formula first. The formula of value of preferred stock is dividend in RM divided by rate of return. So, the dividend must be in RM. Remember class, in RM. So, to calculate in RM, you must times 8.45% with par value of 50 ringgit divided by rate of return 9.9%. So, you will get 42.68 ringgit for the value of preferred stock. Should Atul buy the preferred stock? Atul should not buy the preferred stock because the market value is RM50 is overvalued for 42.68 ringgit. For the second onward calculation, it will focus on common stock. The first one is zero growth. You should note that under a zero growth model, the amount of dividends for each year is the same. Hence, it would be correct to take the dividends in year 1 to the same as the dividend in year 0. So for this question, the answer will be, first of all, you need to extract the information. So from the information, you will know that the dividend is RM 5 ringgit and the rate of return is 15%. Next, the calculation process where you use the formula. The formula is dividend divided by rate of return. So from the information, you just put in the amount. So you will get 33.33 as the zero growth common stock. Next calculation is on the constant growth. Based on the question, as all of you know, you should first extract the information. Class, please do not make a careless mistakes in extracting the information for your final exam. So, from the information, you will know that the dividend is equal to RM2.50 and the D1 is 2.75, growth is 10%, and the annual rate of return is 15%. So the next step is to calculate. From the formula is dividend divided by rate of return minus annual dividend growth rate. So you will get 55 as the constant growth. Lastly is the calculation on the variables growth. So based on the question, as we all know, as I have mentioned earlier, the first step is always to extract the information. So from this question, you will know the dividend DO, growth G, and the annual rate of return K. Based on the information, the question have give the DO. So from the DO, you need to calculate D1 until D5. How to find D1 and so on? D1 is equal to DO times with 1 plus G. And the last step is the calculation process. In this step, just put in all the information into the formula. Remember, the last calculation, you need to add this formula. With that, I thank you.